I'm Nicolas Bornozis of Capital Link, and I would like to welcome you to today's podcast, the podcast series Trending News, where we have the opportunity to discuss with company management on the company's development, strategy, and sector outlook. And we have with us today Mr. Carlos Balestra de Mottola, who is the Chief Executive Officer of D.A.C International Shipping. D.A.C International Shipping has been listed in Milan since 2007 under the ticker symbol DIS, and since November of last year, D.A.C International Shipping also trades on the OTCQX in the United States under the ticker DMCOF. D.A.C International Shipping controls a fleet of owned and chartered-in vessels, 33 in total, 21 MRs, 6 Handy, and 6 LR1s, with an additional 4 LR1s on order with deliveries in 2027. As the company has stated, one of their competitive advantages is the young and modern age of the fleet, which is about 9 years old compared to the industry average that is much higher. And 82% of the fleet is IMO class and eco design, compared again to the industry average, which are much, much lower. With that, I'd like to also mention that our podcasts are strictly for informational and educational purposes. They do not constitute any advice. And again, they are for informational and educational purposes. And with that, I would like to welcome Carlos to our podcast today.
Thank you, Nicolas. Good morning.
So, as I mentioned before, our call, by the way, I'd like to mention as an additional disclosure, we have the privilege to work with D.A.C International Shipping on investor relations, so we're delighted with this close relationship. So our call is not, as I said, about earnings, it's more about developments, company strategy, and sector outlook. So still, let me ask you, you mentioned in your recent earnings presentation that the 9 months for 2024 have been a record year for you, and despite the softening market conditions in the third quarter. So can you elaborate briefly the main factors contributing to this performance?
Yeah, thanks, Nicolas. I mean, the simple answer is that it was a very strong freight market that we benefited from. But then the question is, why did we have such a strong freight market? And what we did before to position ourselves favorably to be able to benefit from that freight market. And I think that in terms of the drivers of the freight market, undoubtedly the disruptions which the sector is currently experiencing, and linked to the war in Ukraine and the Houthis attacks in the Bab el-Mandeb Strait are playing a very big role. They led to a big increase in ton miles. And of course, there are also some factors which are more linked to long-term fundamentals, which have been driving the strength in the product tanker market, like a very limited supply growth in the last few years, and the ongoing shift in refinery production to the Middle East and Asia, with these new refineries, more modern refineries, displacing refineries in Europe, in the US, and in Oceania, contributing to an increase in ton miles. Then from a tactical perspective, one decision we took at the end of last year was to remain more exposed to the LR1 sector. And that paid off handsomely in the first half of this year. These vessels outperformed the MR vessels by even more than we anticipated. So it ended up being a very good decision to maintain most of our LR1s on the spot market. And then, of course, going further back, these results are also linked to the investment decisions we took years ago, the renewal of our fleet, which was pursued with vessels ordered between 12 and 14 and delivered to us up to 2019. 22 new vessels, which we currently control and make the bulk of our 33 vessel fleet.
Thank you, Carlos. I'd like to focus on a few key pillars of your strategy.
Yeah.
One of them is your deleveraging plan, coupled over time with the exercise of purchase options. And as you have stated in your presentation, this has enhanced your structure and profitability. Can you share with us how this works?
Yeah, no, we had a lot of leverage, undoubtedly. I mean, we had many bad years before we started benefiting from the current strong markets. We had to pursue a number of sale-leaseback transactions to shore up liquidity, to be able to confront those weak markets. So our leverage ratio by the end of 2018, measured as net financial position to fleet market value, had reached 73%. But we were able to reduce this leverage ratio to 6.2% by the end of September this year, thanks to the very strong results, mostly, that we have achieved over the last few years. What we have done more specifically is reinvest a lot of the liquidity that we generated through the strong markets to exercise options on vessels we had on TC in. We had 6 vessels that we time chartered in long term from Japanese owners on which we had such options. They were all very much in the money, and we gradually exercised these options over the last few years. We also exercised a number of options on vessels on which we had done sale leasebacks, and that we controlled through bareboat charter contracts. Often we exercise these options only with our own liquidity, without having to use bank debt. So that allowed us to keep our break-even under control over the last few years, despite the inflationary pressures, which contributed to an increase in G&A and direct operating costs. But now that these inflationary pressures have subsided, we expect that our break-even should start declining substantially from next year.
Thank you. Carlos, you have traditionally focused on the MR segment. I mean, your fleet right now, it's 21 MRs, 6 Handys, and 6 LR1s. But you have also started expanding your presence more in the LR segment. You also have these 4 LR1s on order. So what is the rationale behind this development and focusing now on the LR segment?
Yeah, no, we are very satisfied with our performance on the LR segment, and we have done very well with the LR1s we ordered and that were delivered to us a few years ago. They have outperformed the MRs. We believe the sector is interesting because these vessels, they provide more economies of scale than the MRs, but they are the LR1s in particular, because we control LR1s, we don't control LR2s. But they offer more flexibility than the LR2s. So they benefit from the trends that we are seeing now of increasing average distances, with a lot of products being exported from Asia and the Middle East to Europe. But at the same time, they are flexible enough to be a vessel which allows us to achieve some interesting triangulations, which then leads to some very attractive returns. And in addition to that, it is a sector which was a bit overlooked. A lot of the owners focused on the LR2 sector when ordering recently, and therefore the fleet, LR1 fleet, was aging rapidly. 76% of the LR1 fleet by the end of 2025 will be more than 15 years of age, according to our estimates, and 18.5% will be more than 20 years old. The order book grew recently. Some more orders came after we ordered our vessels, but it's still at a reasonable level. And if we include the Panamax vessels, the non-coated LR1s, let's say, the order book is at 12.8%. So it's still very reasonable given the potential for demolitions. And even before demolitions occur, it's also good to remember that as these vessels age, they become less productive. And especially as they cross the 20-year threshold, they face a lot of limitations on how they can be employed. So we think that the outlook is very good. Of course, we recognize that all the segments, all the product tanker segments are very correlated. So it is important to look at the wider picture. And in addition, the product tanker segment is also strongly correlated with the crude tanker segment. And that, I believe, is actually good news today, given the strong outlook also for the crude tanker markets going forward.
Carlos, for the benefit of our listeners who may not be very familiar with the difference between LR1s and LR2s, do you mind telling us a little bit the difference between the two and why LR1s give you more flexibility?
Well, it's just a question of size, and they are able to access certain terminals that the LR2s are not able to access in South America in particular and in Southeast Asia, and therefore they're more suitable for certain trades. So it is true that it is a less liquid market. There are less LR1s today already on the water, and there will be even less so in the future relative to LR2s. And the LR2s do provide more economies of scale. But for certain trades, this flexibility that the LR1s offer is required, and therefore they have their niche there where they're able to do very well still.
Thank you. Now, let's look at fleet expansion. You mentioned in your presentation, which I thought was a very interesting point, that freight rates have increased more than asset values, which means maybe that's an opportunity to expand the fleet. So are you likely to consider any fleet expansion? And you have been utilizing quite significantly the mechanism of chartering in, purchase options, and so on. You've also had some new building orders. So are we likely to see some activity there? I know that you have 3 in-the-money purchase options that you could exercise.
Yeah, Nicolas. No, I mean, freight rates are more volatile than asset prices, right? And so freight rates, they did move even higher than what we have seen in the last super cycle peaks, while secondhand vessel prices still have some way to go. New building prices are pretty much aligned with the last super cycle peaks, but secondhand prices still aren't. So, that doesn't mean that we want to order more vessels. I think we were very fortunate to have these options that we could exercise. The vessels we bought through these options, the TC-in vessels, they were actually younger than the average age of our fleet. They were 6 to 7 years old, and the average age of our fleet is 9 years old. And so they allowed us to reduce the average age of our controlled fleet. They are good vessels. They were built in good yards. We have controlled them since they were delivered from the shipyard. So we knew them very well. And we had employed them very successfully over the last few years, and we have invested and will invest almost 190 million to exercise these options on these TC-in vessels. So that is quite a big figure. And as you correctly mentioned, we still have options on bareboat chartered in vessels, but these for us are more like financing deals. These vessels, we have also purchase obligations, not only options. We are not exercising them yet. 2 of them we could already exercise. One we have to wait until September next year. but we are not exercising them yet because the implicit financial cost of these transactions is actually very attractive, especially in the high interest rate environment we are currently in. So if, as expected, interest rates come down next year, then it is likely that we will be exercising these options next year.
Now, let's move on and look at your chartering strategy. Given the current market conditions and your market expectations, are you opting for higher spot or for higher charter cover?
We have a balanced approach. Today, we have 25% of our 2025 days covered through fixed rate contracts, and 17% of our 2026 days covered through such contracts. Average rates for both years very similar, 25.5 for 2025 and 25,000 per day TC equivalent for 2026. So very profitable rates, which increases earnings visibility. But with this level of coverage, we still have a lot of upside if spot markets continue being strong. Nonetheless, we would still like to increase coverage a bit. We would like to increase 2025 coverage to around 40% in the coming months. Occasionally, we do find some very attractive opportunities. Recently, we signed a 2-year contract for a conventional MR vessel at a very attractive rate. And we continue looking for the right opportunities. We are not just going to take coverage for the sake of it, because we still are very confident on the outlook for the market next year in particular, especially in the first half of the year. But if we do find the right deals, we will take them to increase coverage a bit. Yeah.
Thank you. Now let's move on to capital allocation. That's always a very important point for the company and for investors. How do you balance your capital allocation between shareholder returns and fleet expansion, deleveraging, which we have achieved already? I know you've been quite active in terms of buybacks and dividends. So what can investors expect in terms of your capital allocation strategy going forward?
Now, yeah, we do have a very strong balance sheet, as we already referred to. The ratio between net financial position and fleet market value of 6.2%. We closed Q3 with almost 229 million in cash and equivalents. So there is room for us to invest more. There's room for us to distribute more cash to our shareholders. And that's what we intend to do. I already referred to the investments relating to those TC-in vessels that we have exercised. But looking at what is ahead of us, both in terms of the new buildings, the 4 LR1s that we ordered, and the TC-ins, and potentially the bareboat chartered-ins. That would entail a total use of funds of 350 million by the end of 2027. So we do have an important use of funds ahead of us, and also there is room for us to do more buybacks and to pay more dividends. Out of the 23 profits, we paid through buybacks and dividends around 30% of our net profits. We don't have a dividend policy, but in relation to the 24 profits, the sum of buybacks and dividends, we would like it to be closer to around 40%. So we recently announced an interim dividend of 30 million that will be distributed to our shareholders by the end of November. And this year we were also quite active on the share buyback front. We bought back shares already worth 8.3 million euros this year.
Thank you. Now let's move on to the product tanker sector and the outlook and your take on it. Let's start with the fact, as you mentioned in your earnings call, part of the market softening in Q3 has been the fact that vessels trading crude have been changing into product trades. And you had mentioned actually that 13% of the long-haul voyages going east of Suez were made by uncoated vessels, which was making a 25-year high. Do you expect this to change?
I do, and I think it is already changing, Nicolas. Typically, crude tanker markets improve 1 month ahead of the product tanker market. So already in October, we have seen an improvement, in particular for Suezmaxes and Aframaxes. Now they're not firing on all cylinders, but they are doing much better already than they were doing this summer. VLCCs are lagging a bit behind, but as a result of this improvement and the relative weakness we are seeing currently on the product tanker markets, we saw already a big drop in the cleanups for Suezmaxes and Aframaxes, and we have seen no VLCC cleaning up since September. So that I think will help the markets as we enter the winter months in the northern hemisphere.
Thank you. Now, another factor impacting the market has been the trade disruptions because of the Red Sea, because of sanctions. We're talking about the dark fleet. So what is your take exactly on the Red Sea sanctions? And now we also have elections in the US, which may signify a different policy. So what is your take on?
No, these disruptions were, very important. Suez was always an important passageway for product tankers. Because of the war in Ukraine and the increase in trade flows going both southbound and northbound, it represented by the end of last year around 12% of all refined product volumes, which were crossing the canal. So when the Houthis attacked, became more aggressive in the beginning of this year, the large majority of ship owners, which are not linked to Chinese or Russian interests, decided to go the longer way through Cape of Good Hope, which means that depending on your departure port and your arrival port, your sailing time can be 30 to 65% longer. And so I would say that led to an increase in demand for product tankers of around 3 to 4%. And in addition, the war in Ukraine and the reshuffling of exports from Russia into Europe led to also an important increase in ton miles. These volumes were exported so instead of being exported to Europe, they were exported to Latin America and Brazil in particular, to Asia, to the Middle East. Some stayed within the Mediterranean. They went to Turkey or North Africa, but a large portion went to more distant locations, and then Europe replaced those volumes also with volumes coming from more distant locations. So I would say that the ton-mile effect of the Ukrainian conflict and the sanctions that were imposed on Russia as a result of this conflict is around 5% increase in demand, also 5 to 6% increase in demand. So overall, they were very impactful. And the dark fleet is also, of course, a factor in many ways. There are possibly around 1,000 tankers, over 1,000 tankers, that to some degree were involved in dark trades. Not necessarily all these vessels were doing illicit trades. Some of them might be calling Russia under the price cap. But nonetheless, it is a very big number of vessels. And the other issue is that these vessels are very old, and we suspect that they are very badly maintained, and so they represent a navigational hazard. Some of them, they tend to operate in both markets. They tend to trade sanctioned cargoes, or at least Russian cargoes within the price cap, but also non-Russian cargoes. And of course, they are not the first choice of charters when they come, when they do non-Russian business. So they do tend to bring down the market for the other players also, which is not positive. But authorities now seem to be taking a tougher stance on these vessels, in particular on those which are doing sanctioned trades. There are 130 vessels which were already explicitly sanctioned. So there's room for many more vessels to be explicitly sanctioned, and that would be very positive for the navigational safety, but also for the markets.
Thank you. Another factor to consider when it comes to fleet supply is the fact that environmental regulations are becoming increasingly more stringent. That's an area where you are well positioned given the modernity and eco-design of your fleet. So what is your outlook regarding exactly fleet supply given the environmental regulations are becoming more strict and the aging profile of the fleet?
No, it is the environmental regulations are going to become increasingly an important factor going forward. The EU ETS and the Fuel EU in particular, and there are other regions which could enact similar regulations, and also at the IMO level there are discussions ongoing for an harmonizations of the regulations, which could also end up being very impactful for shipping. So that will penalize all the tonnage and should lead to further scrapping. Of course, as long as markets continue being very strong, the scrapping will not happen or will be delayed as much as possible. But eventually it will arrive. And it's interesting that between I like to look at the product tanker segment together with at least the Panamaxes and the Aframaxes, the non-coated vessels in these sectors, because of the fact that the LR2s tend to switch very often between clean and dirty trades. So I think it's better from an analytical perspective to look at the combined fleet for these segments. And in that case, the order book is for product tankers together with Aframaxes is of around 17.1%, but you have 15.3% of the fleet which is already more than 20 years old. So despite the big order book that we have today for the LR2s, if we then combine it also with the Aframaxes and the other product tankers, the situation is much more under control. And you have a large portion of these vessels which are going to be reaching 25 years of age from 2028. So from 2028 to 2031, on average, around 5% of this fleet is going to reach 25 years of age each year. So, and then thereafter, you're actually going to have an increase in the percentage of vessels reaching 25 years of age, peaking in 2032 at around 8%. So it is quite significant. And so there's a lot of room for scrapping, which should support markets going forward.
Thank you. Now let's move on to the last portion of our discussion. Let's move on to the demand side. And let's start with a question for the more immediate term. You mentioned that gasoline and jet fuel are the main demand drivers for 2024. Is this likely to continue? What else can we count in terms of demand drivers looking ahead?
Yeah, this year was peculiar in the sense that gas oil was very disappointing. And gas oil was very disappointing because of the weak industrial activity in China, the weak construction activity in China, but also in some European countries. And so we actually had a contraction in demand for gas oil this year. Next year, the International Energy Agency forecasts that naphtha and jet fuel should be driving demand growth, and that is not surprising to me. And I think that these products will be driving demand growth for a number of years going forward. But next year we will have possibly a normalization of the gas oil demand. If the Chinese authorities are able to stabilize and revive the economy, they're working hard now at approving measures to stimulate the economy. Markets are not still in love with these measures. More might be needed, but they seem to be realizing that something has to be done. And so hopefully that will also help demand for gas oil next year.
Thank you. Now, Carlos, the refinery landscape is changing, and that creates, I think, that has long-term implications on demand. Can you elaborate on that?
Yeah, I mean, this is something we have been seeing for a long time, right? With refineries, new refineries being built in the Middle East, in Asia, which are more modern than the refineries which have been operating for a long time in the east coast of the US and in Oceania and in Europe. And so they are gaining market share, right? Often they are leading to outright closures of refineries in these countries. Sometimes they are leading to conversions of refineries into biorefineries in these countries. But in any case, they're leading to lower throughputs because they are less profitable. So interestingly, for example, next year, the International Energy Agency anticipates an increase in refining throughput of only 0.6 million barrels per day, which is not a spectacular number. But then if you look more carefully into the breakdown, into the composition of this increase in refining throughput, you actually see that 1 billion, it is forecasting an increase of 1 million barrels per day in non-OECD refining throughput and a contraction of 0.4 million barrels per day in OECD refining throughput. So that should be positive for ton miles, and this is a trend that we expect to continue in the coming years, not only in 2025.
Thank you. Carlos, we've reached the end of our discussion. Before we conclude, any final remarks from your side? I mean, you gave us a fairly positive outlook on the product tanker market, and you talked about your strategy. So maybe you can conclude with your positioning in the market and what you expect looking ahead.
Yeah, I think a lot of these points or possibly covered, relating to our positioning. But yeah, we have a young, modern and fleet, high quality fleet built at very good yards. We are the management of our fleets is a priority for us. High quality technical management. The fleet is increasingly eco. 85% of our controlled fleet today is eco, average age of 9 years. We have a balanced contract coverage strategy, which provides earning visibility and some downside protection in case things don't turn out as well as we expect, but also allows us to retain substantial exposure to the expected strong spot markets. We have a very low leverage, so very strong balance sheet, which provides us a lot of flexibility to be able to benefit from investment opportunities as they arise. We have an important use of funds already. We are already committed to through these options. Also important to remember that these options we are exercising are at values which are well below current market values. So we are buying these vessels very cheap. We have a very strong and cohesive team with a lot of very experienced professionals. And we have a very long-term, valuable relationship with charterers, but also with capital providers in different locations around the world, which allows us, to pursue our projects and have access to competitive costs of funding and attractive employment opportunities for our vessels.
Thank you very much, Carlos. It's been a pleasure to discuss with you. I'd like to remind everybody that we had the opportunity to discuss with Carlos Balestra de Mottola, who is the CEO of D'Amico International Shipping, and we talked about the company's development strategy and the product tanker sector outlook. Carlos, thank you very much for being with us.
Thank you very much, Nicolas.